Rich Krafcik. I'm with Cobblestone Asset Management, and I'm standing next to the efficient frontier. So I want to speak to you a bit about what this means and how we use it. We have return on the y-axis, we have risk on the x, and this line here is the efficient frontier. It represents the optimal trade-off between risk and return, getting as much return as possible for every level of risk we're willing to take. So if there's a portfolio such as this one that's not on the line, it naturally has some inefficiencies. And you might think, well, how often do we run into a portfolio that's not on the line? Probably more than you expect. So we see individuals managing their own portfolios, other advisors that just don't have the process and the detail to actually shift a portfolio on that line. So just so you understand the principle, if this dot right here is a portfolio, we can shift it up to the line, getting more return for the same level of risk, or we can shift that left, encountering the line over here, getting the same expected return, but now we're at a lower risk profile. So that's easy to draw in a textbook, it's easy to talk about in a classroom. In the real world, this line is moving all the time. You have changes in consumer sentiment, earnings reports, companies miss estimates, they beat expectations. You have changes in corporate guidance, currency shifts, policy fluctuations, interest rate changes. I could go on, and we can make a list that would just continue. But the reality is this line, even as I stand here speaking, is shifting. So what we've done is we've built out a suite of portfolios on this line, and we feel we have a couple core responsibilities. One is to follow the market's current pricing and make sure that these portfolios are efficient. And just as important is for the investors we work with, getting their investments on the right place on this curve for them. So over on this side, we'll have capital preservation. As we shift a bit higher in risk, we see income-oriented portfolios, and then total return or growth and income portfolios, shifting to growth and even pure or aggressive growth portfolios over here. So you think about, well, where should we be on this line? Everyone has unique factors, so I'll speak to a couple of scenarios that we run into frequently. If someone is currently in retirement, then oftentimes we see them shifting towards the left side of this curve. If someone has a long time till retirement, with their retirement money, they're usually going to be focused more on growth because they have the timeline to ride through the ups and downs in the market. But there are so many intricacies, and this is where it gets fascinating for us. So you could have someone that is in retirement, but at the same time, they may have strong income sources and they don't need to tap a significant portion of their funds on a regular basis. So if that's the individual we're working with and the market has just presented an opportunity, let's say there's a dip and pricing looks attractive, we may choose to tactically increase risk, knowing that this particular investor, although they're in retirement, has the capability to tolerate some risk in exchange for the potential of higher returns. All right, on the other side of it, we may have someone that's a long ways from retirement, but they may have a non-retirement brokerage account with us. And they might tell us that that money is earmarked for a vacation home or a second home purchase. Let's say they're just waiting to find the right home, or they're waiting for the real estate market to present an opportunity. It makes a lot of sense to shift the risk on that particular bucket of money lower than their retirement funds because the expected use for that money is much nearer in time. So all sorts of factors that drive from the client side where their money should be invested on this curve, and there are just as many factors from the market side. We feel like it's our job to look at the client's timeline and their risk preferences, look at the market and its current opportunities and risks, put these together and find the right place for each account or each bucket of money on this curve. So I want to keep this short. I'm going to stop there. If you want to dive into this a bit further, feel free to reach out to me or my team. I can tell you we spend a lot of time on the portfolios and where we're at in the market cycle, where different clients should be on this line. So we'd be happy to talk to you and talk into your specifics in more detail. Thank you.